Okay, welcome everybody for the last and fifth lecture, Research and Financial Markets. I think this course is compulsory, right, for master students? So, and you are about 60 people in the master program, right? Okay, I'm just a little bit curious since about 25% are just present. So, yeah, the lecture of today should deal with the most recent Fama and French paper from 2018, Choosing Factors, published in the Journal of Financial Economics, which is one of the top journals in finance. But before we start with that paper, I would just briefly like to come back to something that we discussed yesterday, so that there's no confusion about that. So yesterday we were talking about the concept of co-integration. And we are talking about two time series, and each of them is by itself a random walk. Yeah? So it has a lot of bumps in between. And we were arguing that a co-integration, if they are co-integrated, it would mean that in the long term they co-move, they move together. Yeah? So they have the same stochastic driver. And if our time series are integrated or are behaving like a random walk, yeah, if they have a lot of bumps, then the correct methodology is to use co-integration analysis if you would like to show that they share the same stochastic component. Yeah? And in order to ensure or in order to test if those time series are behaving like a random walk or if they are actually stationary means that they look like this, as we said yesterday. Yeah. So they are circulating around a mean, and there are no predictive patterns in this time series, more or less. They are well behaving. Yeah? But sometimes if the time series is very short, then it's not obvious if they are more a random walk or if they are stationary. Yeah? So in order to ensure that they are actually a random walk and that co-integration is the right methodology, we need to test for that. And yesterday we were talking about the Adf test, yeah? Where you basically, each of the time series, now I just for illustration purposes, I just chose now y. So you take the difference of this variable and you regress it on the variable in levels lagged, t minus 1, and you have of course, an error term here. That's the simplest form of an Adf test. And then we are discussing this table here with where you have to compare the t-statistics. Yeah? It's this table here. I've already put it on Moodle. Just check Moodle. So let's say we have 500 observations and we want to have this 5% significance level. So when the t-statistic of this guy here, yeah, and now we have no deterministic terms, that means we have to check the table on the left-hand side. So if the t-statistic of this parameter, of this phi, it's phi in Greek, okay, phi. If this is, let's say, minus 1.6, then this means that our time series is a random walk. Under the null hypothesis, our time series is a random walk. And if this t-statistic is below the critical value of minus 1.95, it means that we cannot reject the null hypothesis that our time series is behaving like a random walk. So in our case, in our paper, we wanted to see both time series. And for both time series, we couldn't reject the null hypothesis that they would behave like a random walk. So both time series were random walks. That's why we could employ co-integration analysis in this research context. Yeah? And now you were wondering, okay, but there are obviously three different tests here. Yeah? Either you don't have any deterministic components here, or you have a constant, and a trend term. This is just a regressor that has the values corresponding to a time series. So if you have 500 time series, it's just a vector of 1, 2, 3, as many time points as you have in your data set. So And this is just a vector of ones, yeah? So nothing special here. So the answer to that question is, I don't know. Yeah? So in best case, or if you have a strong, if you want to have a strong ground for your research, you do all the 3 tests, yeah? And you report your test results for all of these tests. This is what people usually do, I would say. Yeah? And if you want to ensure that your time series are really behaving like a random walk, then in all 3 tests, this point estimate here of your tree should be lower than this critical value reported in these tables. Yeah? Once this is fulfilled, and both time series are behaving like a random walk, you employ co-integration analysis, and then you can show whatever you want to show. Yeah? But if you run this test and it turns out okay, the t-statistics are below the critical values, then we have obviously, statistically, a stationary process. And then co-integration is not the right tool. What we have to use then is principal component analysis. And this is what we will cover in the exercise session. Okay? Any questions to that? So probably you will also find a lot of information in the internet about this kind of stuff. But this is the basic idea, and this is basically, it's not so difficult. Yeah? It's something you can mechanically go through this procedure. Yeah? It's nothing fancy, actually. Okay. I will take this away now, because we need some space for our actual lecture. And as I already told you, this paper is, so to speak, the peak of our lecture series. Yeah? Just a small series of lectures. We had just 5 lectures. So, of course, in 5 lectures, what can you actually cover? Obviously, not so much things. And the main idea is, obviously, that you get an idea about what is the up-to-date research, yeah, in finance. And, of course, each of us covers a different topic. My topic is related to asset pricing, which is, in my opinion, and my humble opinion, the most important field in finance research, because the Nobel Prize in economics has been given twice to research in asset pricing. Last time in 2013, when Fama got the Nobel Prize for his research related to the 3-factor asset pricing model that you know from your bachelor studies. Yeah? So this is his latest paper from 2018, also published in the JFE. He usually publishes all papers in the JFE, which is a top finance journal. And this paper is entitled Choosing Factors. Yeah? So what is this paper about? So first of all, we know already from our first lecture, yeah, we were discussing the paper Replicating Anomalies, yeah, where we figured out, okay, these researchers, they were trying to replicate a set of 452 different asset pricing anomalies, and they figured out that 65 of these 452 anomalies cannot be replicated. Yeah? So they fail replication. And their study was based upon an earlier study from Harvey, from a 2015 paper, who also goes through 316 different anomalies. Yeah? And all of these anomalies are potential risk factors. If we talk about the Fama and French 3-factor model that you know from your undergraduate studies, you know the size factor and the value factor. Both of these factors have been earlier proposed as anomalies in the literature. So, in general, this paper is about testing different asset pricing models. Yeah? And they're talking about left-hand side and right-hand side approach. So if we just briefly would summarize this paper, choosing factors, yeah, it's about left-hand side approach and right-hand side approach in order to select a proper pricing model. Yeah? And the right-hand side approach can be distinguished between testing nested models and non-nested models. So that's the general frame what this paper is all about. If you want to compare asset pricing models with each other, then you can. The old approach back in the days was the left-hand side approach, and now in their paper they propose different right-hand side approaches, and one is for nested models and one is for non-nested models. So we can discuss briefly about this left-hand side approach, so that you get the clue of the background. So let's say you have an asset pricing model that has, let's say, 3 factors, F1, F2, and F3, and you want to test this model and take it to the data. So you use, let's say, 25 assets, test assets, on the left-hand side. For instance, usually what people take are test assets sorted by size and book-to-market ratio. So you take the excess returns, let's say R1 is the excess return of your first portfolio at time t. Here we have the excess returns of the second portfolio at time t. And the last one would be the 25th portfolio in excess terms at time t. And this could be, for instance, portfolios sorted by size and book-to-market ratio, or sorted by size and investment, or investment and profitability, and so on and so forth. That's not so important. But the idea is that you regress each of these assets here that are on the left-hand side on your factor model. Yeah? And because this is a regression equation, you have also an error term. And the last guy is the error term 25 at time t. And then you have, of course, point estimates for your risk factors. So here we have the beta 1, 1, beta 1, 2, beta 1, 3. Here we would have the beta of the second asset, so beta 2, 1. It's the beta of the second test asset against the first risk factor. Then we have the beta 2, 2. Here we have the beta 2, 3, and so on. And our last equation, we have the beta 25, because it's the beta of the 25 test asset against the first risk factor. So beta 25, 1. Here we have the beta 25, 2. Beta 25, 3. So we have a system of equation. And if we want to investigate if our pricing model that consists of 3 risk factors, if this prices our test assets that are on the left-hand side correctly, what we have to do is we have to include an intercept term here, a constant, C1. Here we have C2. And here we have C25, and we run our OLS model. And this is a multivariate model, obviously, because we're operating with 25 equations. So we can do this in e-views, and what we do then is we would test our constant terms here simultaneously Yeah? If they are different to 0. So if the pricing model here that we have consists of our f's, if it can price our test assets correctly, then we would assume that the intercept terms, which in essence measure the part of the excess returns unexplained by our factor model, if they are simultaneously 0. So under the null hypothesis, we test, okay, is C1 equal to C2, is equal to C whatever, equal to C25, is equal to 0. Yeah? So are all of these guys equal to 0? If this is fulfilled, well, then our pricing model works very well. Under the alternative hypothesis, at least one of these Ci is unequal to 0, where I can be 1 to 25. Yeah? So, and then you can imagine, let's say you have one factor model where the first factor is, let's say, y1, and the second factor is y2, and the third factor is y3. It can be, okay, let's say you have a model that has the size, value, and investment factor. Then you have a second model there we have x1, x2, and x3. These are now your 3 risk factors. Then you test, okay, your second asset pricing model has maybe size factor, momentum factor, and profitability, or return on investment, or whatever. So you have 2 different asset pricing models where that you insert in your factor model here. And then you, for your 2 models, you estimate the intercept terms. So then you can conclude, okay, this model performs better, where on average the intercept terms here are lower, right? Because the intercept terms, or the average, let's say the average of the intercept terms measure the average mispricing of our model. The lower the average mispricing, the better the model, right? It's logic. So the thing is now, okay, if you use, let's say, 25 test assets sorted by size and book-to-market ratio, it could be that maybe the first model performs better. Maybe the first model shows you that the intercept terms are on average lower compared to that model. But what's the problem with that approach? What's the problem? So the problem is, okay, if we change the set of test assets here, if we would use, for instance, in the first run, we use 25 test assets sorted by size and book-to-market ratio, and then we test our model, which one performs better, and then we figure out, okay, and for this set of test assets, the first model performs better. If we now use test assets sorted by, let's say, profitability and investment, it could be that the other model performs better. We don't know that. But how do we decide then which pricing model is better, the first one or the second one? Obviously, we get different results depending on what is on the left-hand side. That's the problem. And that's the reason, or that's the motivation for the paper, or the main motivation as far as I'm concerned. Because having the right-hand side approach, what they talk about in the paper is very different. Because the right-hand side approach, you compare the maximum squared Sharpe ratios that your model produce. And based upon the maximum squared Sharpe ratio, you make a decision which of these pricing models performs better. But this is just one part. This is for non-nested models. But we will talk about it now in more detail. But the problem is that depending on your left-hand side test assets, you might come to different conclusions. And you want to make a proper decision. So from your graduate studies, I have to take this away now. So hopefully you are fast enough. So from your bachelor studies, you know already the two-factor model, which you see here in equation 4 of their paper. Yeah? Or basically, what you see here is the six-factor model. But from your undergraduate studies, you know the two-factor model, which consists of the market factor in excess form, the size factor, which is a portfolio or zero-cost strategy that is long on small stocks and short on big stocks, and the value factor, HML, high minus low book-to-market ratio, which is a zero-cost portfolio where you buy stocks that have a high book-to-market ratio and you short-sell stocks that have a low book-to-market ratio, the growth stocks, right? So then in the 2015 paper, yeah, they add two more factors, which is RMW, which is the so-called profitability factor, which is a zero-cost strategy that invests in stocks that are profitable and short-sell stocks that are unprofitable. Yeah? Robust minus weak. And also the investment factor. So that's the five-factor model. CMA is the investment factor, which means conservative minus aggressively investing firms. So this is a portfolio, a zero-cost strategy that invests in stocks or in companies that had a low asset growth, yeah, in the previous period, and short sell stocks that have a high asset growth. Since the investment factor is basically, it tells us that firms that invest a lot tend to underperform or tend to generate lower returns than firms that invest only a little. So that's the five-factor model from the 2015 paper. It's also published in the same journal, in the Journal of Financial Economics. Now, in their 2018 paper, they add the UMD, which is in their paper the notation for the momentum factor. Yeah? And they do this even though, according to Fama and French, this factor lacks theoretical grounds. Yeah? The five-factor model is derived upon the discount factor model. Yeah? It's related to an umbrella theory. Yeah? The discount factor. You can, if you go through the 2015 version or the 2015 paper from Fama and French, you will see this equation. I think it's the first equation in that paper, yeah? Where they basically derive for why they motivate to include the profitability and investment factor, yeah, in the model. But it's just an umbrella theory, yeah, the dividend discount model. So they test, first of all, different factor models. Yeah? And now we are talking about nested models. This is what they do in section, let me see. In section 4. But first of all, we have to talk about how to compound these factors. Yeah? I made you a small picture here. So, and this is basically, once you understand the principle for how to compound one of these factors, you know how to compound the others as well. So this is the whole stock universe. Yeah? So we have the whole stock universe of US stocks, and you divide them into some groups here, obviously. Yeah? So we have a group of big stocks, yeah? And you have a group of small stocks. Yeah? So the big stocks you put in here, the small stocks you put in here, and then you divide the stock universe also in high, medium, and low. Yeah? So we have in total 6 groups. And high, medium, and low. High can be high book to market ratio, or high asset growth, or whatever, high profitability. So it doesn't matter. So it's one of these 2 sorting dimensions. Yeah, one sorting dimension is in size, and the other one in the other characteristic, which can be profitability, investment, or whatever. Yeah. So then you compound. You have now 6 groups. Yeah. Big and high book to market ratio, for instance. You have big and medium book to market ratio, big and low book to market ratio, and the same for the small stocks. Yeah? So you have 6 groups of stocks. So then you compound first the valuated. So you valuate the stocks in each of these groups. And then you go high minus low. So you buy this group here and sell this group here. So high minus low. And that's for the big group, so B. So you do the same for the small group. So you buy these stocks here, and you short sell these stocks here. So then you have, again, high minus low, but for the small stocks. What you do then is, so because here we have value weighting, so each of these stocks is weighted corresponding to the market capitalization. What you do then is you compound the equal weighted return, 0.5. So half of the weight is in this portfolio here. H minus LB plus 0.5 H minus LS. Yeah. That is how they compound the risk factor. And if the sorting characteristic here on this dimension is book to market ratio, then this would be our value factor, our standard value factor. Yeah? If the sorting variable in this dimension would be profitability, so here we would have high profitability and here low profitability, and here small and big stocks, then this would be our profitability factor, the standard profitability factor. What they do then also in the paper is they introduce 2 different candidates. We have cash profitability and operating profitability. So then we have here also then either high in cash profitability or high in operating profitability. It's just a question of how you define the profitability measure, but then you have, of course, then a different factor. It's either cash profitability or operating profitability. But the way how you combine it, the methodology is, of course, the same. And the same is for investment. Yeah, so this is the way how we calculate it. But what you can also do is you can have, so if this is your value factor, yeah, your standard value factor, for instance, if we now consider book to market ratio, if you just take the return of this guy here, then you would have the small factor for small stocks. Yeah? If you just take this guy here, that's the return, that's the small factor part of the return. Or the part of the return that is related to the small factors, or to the small stocks. So if we take just this guy here, we can use this one as a small stock factor for value. Yeah? Or depending on what we have here, for profitability, investment, and so on. So you can have the standard factor, and you can also just take the small factor. This is also what they do in the paper. But let's first focus on the standard factor. Yeah? Now we want to investigate, we want to test the pricing characteristics of the standard model. So the first interesting table in this paper, so first of all, we want to check the descriptive statistics. This is always where you start with, also when you write a master thesis. you have to report the descriptive statistics. Yeah. So over the sample period, this is what they report here in table 1. Yeah. You see, if you just consider now, for instance, here the left-hand side, they report the monthly average returns of these different factors here that they compounded here. Okay. So, for instance, let's consider here like the first row, yeah, where we have HML, RMW, CMA, and UMD, like our 4 factors, and here the average return. So they report, for instance, for the value factor, the standard value factor that consists of our big and small stocks. It's 0.35. So 35 basis points per month payoff if you run the value strategy. Yeah. With the T statistic, what you see on the right-hand side is 3.15, which means it's statistically significant on any level. Even after accounting for multiple testing, yeah, we have already discovered from our lectures that we have this higher T value, yeah, of 2.78, yeah, and obviously, if we consider the whole sample period here that Fama and French investigate, and it starts in 63, yeah, they investigate the sample from 63 to 2016, we see that the value factor obviously generates significant average payoffs of 35 basis points. Using operating profitability as our sorting characteristic here, we have an average payoff across the sample of 0.24, so 24 basis points per month, with a T statistic of 2.75. It's also highly significant. Using cash profitability, we have 50% more. Now the payoff is 0.33, 36 basis points per month, and the T statistic is much higher. Yeah? We have 4.71 is a T statistic. It also generates significant payoffs across the sample if you run this strategy. Investment, 31 basis points per month, T statistic 3.88, and momentum 0.69. 69 basis points per month with a T statistic of 4.09. So as you see here already from table 1, you see already that momentum obviously generates the highest payoffs. Yeah. Now in the second row here, they report the corresponding point estimates using just the small stocks. Now we're just using just the small stocks here and running our strategy. So we are now here. Yeah? So if we just use small stocks and we run our value strategy, we have 0.51. Now we have 51 basis points per month. T statistic is 4. If you consider now momentum, 92, almost 1% payoff per month with a T statistic of 5.47. So if we just use small stocks as our risk factors, yeah, in compounding our risk factors, the payoffs are higher and the T statistics are higher. This is already what we learned from table 1. Yeah. In the third row here, they report the results for using just big stocks. Yeah. Now we are here. We just use this part here for constructing our risk factor. Yeah. So what we see here is the payoffs are much, much lower, and the value factor and profitability factor using operating profitability do not even manage to generate significant payoffs. Yeah? We know from yesterday, we remember, or probably you know it anyways, the critical values of the standard normal distribution, 1.96 minus 1.96. Yeah? So those T statistics, 1.57 and 1.76, do not even pass the simple hurdle of 1.96. So they are insignificant. Yeah? And here the investment factor is just here on the border, 1.96. Yeah? But if you would now use our higher T values of 2.78, none of them is significant anymore. Yeah? So big stocks obviously do not generate the same payoffs as if we would use small stocks. So the major driver for our strategies is obviously the small stock universe. Yeah? Here upwards, in the upper part of the table of panel A, they report also the average returns for the size factor, small minus big. And obviously, it's very low, 26 basis points per month, with a t-statistic of 2.17. So over the whole sample period, the size factor generated, at least using standard t-statistics, has been profitable or generating profits. But we will come back later to that issue. So that's the takeaway for table 1. So now I will take this away now. I assume you have understood the concept. So I told you the major contribution here is the right-hand side approach, and let's talk about nested models. Nested models. So you know from your undergraduate studies the CAP-M, which consists of the excess market factor. And the Fama and French factor consists of the excess market factor. Then we have the size factor, SMB, and the value factor, HML. These are nested models. Because the CAP-M, that's the CAP-M here. And this is the Fama and French 3-factor model. So the CAP-M is nested in the Fama and French 3-factor model. Because it has the same regressor in common. So if we want to decide which model to choose, if we choose the Fama and French 3-factor model against if the Fama and French 3-factor model performs better than the CAP-M, we have to employ a test for nested models, since the CAP-M is nested in the Fama and French 3-factor model. In the same manner, if you want to test the Fama and French 3-factor model against the Fama and French 5-factor model, we also have to run, or we have to employ a test for nested models, since the Fama and French 3-factor model is nested in the Fama and French 5-factor model, since the Fama and French 5-factor model and 3-factor model has the same regressors as the Fama and French 5-factor model. The only difference is that the 5-factor model has 2 more regressors. And the same is for the 6-factor model. If we want to test if the 6-factor model of the 2018 paper performs better than the 5-factor model of the 2015 paper, it's a test for nested models. So we have been discussed in the beginning of the lecture about the left-hand side approach, where we had our test assets on the left-hand side, and then our factor models on the right-hand side. And then we were testing, the intercept terms. We were testing if they are simultaneously different from 0. And you can do this actually, if you have 25 test assets, you would run the F test or the wall test. If you use the wall test, and you have 25 test assets, and you have 25 intercepts to test simultaneously, the test statistic would be chi-square distributed with 25 degrees of freedom. So if you would test this model here, the CAP-M against the Fama and French 3-factor model, how would we do that? So this is what we see here in table 2. You do it by employing spanning tests. So what you see here is now you employ at the left-hand side variable. We don't have test assets like in the left-hand side approach. We have now, sorry, I have to move back. I think you had yesterday the same problem, right? This computer does what it wants. So instead of having test assets on the left-hand side, we have here our new risk factors that this new model has more on the left-hand side. So the three-factor model has the size factor and the value factor in addition to the exact market factor that the CAPM has, right? So as a left-hand side variables, we use now a vector, the size, the vector that corresponds to the size factor, and one vector of returns corresponding to the value factor. Yeah. So in matrix notation, we can do this very simple in MATLAB or also in eViews, and I know that some here have taken the MATLAB course, so for them it's obviously very easy what's going on here. So let's denote SMB, yeah, it's a t by 1 vector. So we have t observations in our sample. It's a t by 1 vector that captures the size factor. So the first component is are the returns of the size factor at time t1. The second component is the return of the size factor at time t2, and so on and so forth. And the last component of this vector are the returns of the size factor at time t. In the same manner, we have a vector for the HML, for the value factor. Yeah? So we have again a t by 1 vector because we have capital T observations. First component, obviously, is the return of the value factor at time t1. Second component at time t2. And the last guy here is the return of the value factor at time t, capital T. We also have a vector of excess market returns. Yeah. Then we have a vector, we define a vector of ones that has the same dimension as all of the other guys here. So we have a vector of ones, t by 1 vector. So, and this is then how our system of equation would look like. Yeah? Now remember, this SMB is a t by 1 vector. Yeah? So HML is also a t by 1 vector. So this guy here, this vector here, is a 2 times t by 1 vector. What we have here is our big X matrix. Yeah? The first element here is t by 1. It's a vector of ones. Second element is a vector of exact market returns. It's also t by 1. This guy here is a t by 1 vector of zeros. This also is a t by 1 vector of zeros. In the same manner, we have the same guys here. Yeah? The first guy here is a vector of zeros. Second guy is a vector of zeros, which has the dimension t by 1. Then we have a vector of ones and the excess market factor. So this matrix here has a dimension 2 times t by 4. Yeah? 4 column vectors. It's a block matrix. Yeah? We have here blocks of ones, of zeros, sorry, and here is the block of zeros. And this block here is the same like here. There's a block matrix. You know this from linear algebra. So we have 4 point estimates, obviously. So the first guy here, beta 1, is the point estimate for this guy here, for our intercept term. Beta 2 captures the point estimate against the market factor. And beta 3 is for this guy here, and beta 4 for the fourth element here. And we have a vector of error terms here. So it's a system of equation. We can just easily estimate using MATLAB or also in eViews. And what we are then interested in, we are interested in if beta 1 and beta 3, if they are equal to 0. So we test basically if in the context of the Fama and French model, three-factor model against the CAPM, we would test if the If once we regress our size and value factor, if our intercept term leaves something unexplained. So is the CAP-M able to explain the returns of our size and value factor? If the CAP-M is not able to explain the returns of our size and value factor, then we would choose the 3-factor model against the CAP-M. That's the basic idea. So this is what they report here in table 2. So they regress. Here on the first row, you see SMB, intercept, and market factor. Yeah? So you regress. On the left-hand side, you have the size factor, and you regress it on the intercept term and the market factor. So on the right-hand side, you'll see the corresponding t statistics. So the intercept term for the size factor is which is 0.17, has a t statistic of 1.46. Yeah? So it's insignificant. So we can say from the first equation, okay, the market factor is able to explain the returns of the size factor, univariate considered. Yeah? If we just consider univariate the size factor itself. For the value factor, then we regress also the value factor on the intercept term and the market factor. Yeah? So the intercept term is 0.43. So it's the part unexplained by the CAP-M, obviously. So the t statistic is 4.01. So now we cannot say so much. So what we have to do now is we have to test simultaneously, because this is a model. Yeah? So we have to test now simultaneously if those two intercepts are statistically different from 0. And this is done in panel B. Yeah? You test the CAP-M against the Fama and French 3-factor model. So and you test if these two intercepts here, if they are statistically different from 0 or not. And the econometric methodology that you use for running this test is a seemingly unrated regression model. Have you talked about that in econometrics? Obviously, you don't know, right? So I don't know either. But this is something that we could also discuss in the exercise, for instance. Yeah. Because it's actually the same test that you also use as a left-hand side approach. But now, as a left-hand side, you have obviously risk factors and not test assets. Although your risk factors are your test assets, if you want. Yeah, that's the idea. So, if this p-value is larger than 0.05, this would mean, okay, the CAP-M is able to price our size and value factor. So in this case, we would say, okay, we choose the CAP-M. We don't need the Fama and French 3-factor model because the CAP-M is able to explain the payoffs of these other risk factors that the Fama and French 3-factor model has more. So what they report then is they want to test the what you see in this area, they test the 5-factor model against the 3-factor model. Yeah? You see now here as regressors, you have again an intercept term, market factor, size factor, and value factor. And then you have here either cash profitability or operating profitability and the investment factor. Yeah? So they report basically for all of these 3 regressors, they report the intercept terms here in the first column. Yeah? And on the right-hand side, you see the corresponding t statistics. Yeah? For instance, if you regress the operating profitability factor on the Fama and French 3-factor model, yeah, you have an intercept term of 0.34. So 34 basis points are unexplained, obviously, by the 3-factor model. And the t statistic is 4.01. And in the same manner, you would interpret the other guys here. Yeah? For the investment factor, 20% per month of the investment factor are unexplained by the Fama interference three-factor model, and the corresponding t statistic of these 20 basis points per month is 3.53. So it's significant on any level. So let's check. The investment factor after regressing on the Fama interference three-factor model has average payoffs of 20 basis points per month. So what's the corresponding value before? Before risk adjustment, let's see here, it's 31 basis points. So after risk adjusting, usually the payoffs are lower. Yeah? After risk adjustment, which means that you regress your payoff series on the risk factor model, usually the payoff is lower. Yeah? So it drops from univariate 31 basis points per month, and after risk adjusting, you have just 20 basis points per month. But anyways, the payoffs are significant because the t statistic is 3.53. So again, we can now, okay, let's just use operating profitability and investment. Who, in this case, you would take this intercept here, which is 0.34 with a t statistic of 4.01, and for the investment factor 0.20 with a t statistic of 3.53. So you will take these two guys here and simultaneously test them if they are equal to 0 or not. I mean, you know now already. I mean, the statistics are so high that obviously the three-factor model cannot explain this payoff series. Yeah. So this is what happens here in the panel B, the second row. Yeah. You test the five-factor model against the three-factor model. Yeah. On the left-hand side, you have the operating profitability and the investment factor, and on the right-hand side, as explanatory variables, you have the risk factors of the three-factor model, which is the market factor, size factor, value factor, and you also include the intercept term, of course. So if you test these two intercepts simultaneously, yeah, using a chi-square test, or in this case, they use the GRS test, which is an F test, obviously. So the p-value is also 0, which means you reject the hypothesis that these point estimates are simultaneously 0. In the last case, you would compare the six-factor model against two different variations of the five-factor model. Yeah? So in the last column, they use cash profitability. So they use the five-factor model regressors, and for proxying the profitability factor, they use cash profitability. And if you regress the momentum factor on this five-factor model, having the market factor, size factor, value factor, cash profitability factor, and the investment factor, 0.61% per month, so 61 basis points per month, are unexplained by this five-factor model. And the t statistic is of this intercept term is 3.55. So in this case, that's the only case actually where we do not need any multivariate test. Yeah? If we test the six-factor model against this five-factor model, because we have only one variable on the left-hand side. In this case, we have only the momentum factor on the left-hand side. So in this case, we just have to check the t statistic here. And if the t statistic indicates that the intercept is significantly different from 0, because it's obviously larger than 1.96 and also larger than 2.78, we can conclude that the five-factor model cannot explain the payoffs of the momentum factor. So obviously, we choose the six-factor model over the five-factor model. irrespective of if we choose the 5-factor model based upon cash profitability or on operating profitability. It's the same result. Yeah? Both t-statistics are larger than 3. Moreover, what we also learned from this table is that we choose the 5-factor model over the 3-factor model because the simultaneous tests here show that the 3-factor model cannot explain the 2 additional regressors of the 5-factor model. And what we also learn is finally that we choose the 3-factor model over the CAP-M since the CAP-M cannot explain simultaneously these 2 additional risk factors, the size factor and the HML factor that the 3-factor model has compared to the CAP-M. So this test we can simply use if we have, if you are operating or if you have nested models. Yeah. So, and they argue in the paper that if you use these tests, it corresponds to the maximum squared Sharpe ratio. That's a technical detail, and but what you need to know in this context is just the methodology that we just here described. But now, what happens if we want to compare 2 models that are non-nested? Yeah? For instance, let's say we have one model, we have the market factor, we have the size factor, we have the value factor, we have the profitability factor based upon operating profitability, we have the investment factor, let's call it INV just for the moment, and the momentum factor, let's call it just MOM. Yeah? And we consider a second model where we have also the market factor, we have the size factor as well, we have the value factor as well, we have also the investment factor as well, and the momentum factor is also the same. But instead of operating profitability, we use a risk factor based upon cash profitability. So these 2 models here, even though most of the regressors are the same, one of them is not the same. That's why we have to choose a test for non-nested models. Or, as an alternative, if you would like to compare the standard factors here with a model that is based upon risk factors using just small stocks. Yeah? If we would have here, for instance, let's say we have here also the profitability factor, RMW, but all of these factors are based upon small stocks. Then we have only one factor that they have in common, and all the others are different factors. Yeah? So this is also, again, we have to use a test for non-nested models. And that's basically what they do in table 3. Yeah? First of all, what they do in table 3 is they compare 2 6-factor models with each other, where one 6-factor model is using operating profitability, and the other one is using cash profitability. Yeah? So it's this profitability factor that is, there's only this one profitability factor that is different in these 2 models. Yeah? So and what they argue is, okay, they use these risk factors of each model, and they compound the maximum squared Sharpe ratio. Yeah? So you know already from your undergraduate studies how you compound the Sharpe ratio, right? So it's the, yeah, you have input assets. Yeah, some assets here, and then you have this mean variance frontier, and then here is one optimal portfolio, yeah, on the mean variance frontier, and this has a Sharpe ratio, and if you square it, you have the maximum squared Sharpe ratio. Yeah. So, and you can do this also for risk factors. Yeah? You can do this for stocks or whatever assets you have here in your asset universe. You can also do it for risk factors. Yeah? So given your set of risk factors, either using the 6 risk factors and one risk factor is based upon operating profitability, you can estimate the maximum squared Sharpe ratio based upon that universe of 6 assets or strategies, if you want. So the Sharpe ratio, according to table, is it table 3? Yes, is obviously based upon the sample 0.135. Yeah? That's the maximum squared Sharpe ratio using these 6 risk factors. If you use cash profitability, the Sharpe ratio is slightly higher. Using the sample, it's 0.19. So the problem is, okay, these estimates can be sample specific. It's random. So what Fama and French basically suggest is then, okay, it's a simulation procedure. So let's say we have here a matrix where we have here our 6 risk factors. Yeah. This is risk factor 1. This is risk factor 6. This is time t is 1. Here we have time t is 2, and so on. Here's time is capital T. Yeah, that's our data matrix. So what you can do is now, you can do it in MATLAB, for instance, or in R, or any other program that is strong in matrix algebra. It's called full sample simulation. So you take one whole row with probability 1 over t. Yeah, you have t observations, so with probability 1 over t, you randomly draw one whole row that has the corresponding risk factor observations in the row vector. Let's say in the first iteration, you grab this row here, and you put it here. It becomes here your first observation in the simulated sample. So then you put it back here. In the second iteration, you again draw randomly one of these rows here with probability 1 over t. Let's say in the second iteration, you grab this row here, the last row, which has the corresponding observations of this risk factor, of the risk factors for time capital T, and this comes here. It's then your second observation. Because you draw with replacement, it could be that some of these observations appear here in this matrix a couple of times. So this is called full sample simulation. So they do this, right? So they construct this simulated matrix until capital T is fulfilled, until you have capital T observations, depending on these rows here, and then you have one new data set. And you can again estimate the maximum squared Sharpe ratio for that data set. And you do this 100,000 times. So you get 100,000 maximum squared Sharpe ratios. Yeah? And if you do this 100,000 times, using this data matrix that consists of the 6-factor model using operating profitability, it has a full sample simulated Sharpe ratio of 0.152. So it's slightly higher than using the actual sample. If you do the same for the 6-factor model using cash profitability, the full sample Sharpe ratio after 100,000 simulation runs is 0.208. Huh? So it's basically the same result as comparing the actual sample. So the problem is with this approach here, with this simulation approach, is that it's upwards biased. This is what they argue in the sample, in the paper. So that's why they propose an in-sample simulation. Let's call it, they call it IS, in-sample, and out-of-sample, OS. They call it in the paper OS. So what that means is, okay, you consider 2 consecutive rows. Yeah? Let's say, again, you draw with probability 1 over t minus 1. Let's say you have in the first draw, you draw this row of risk factors. Yeah? So you construct it, you have an in-sample data matrix, yeah? And this guy here becomes now your first row vector. For the out-of-sample, you take the row that follows here. If the first row is, if for the in-sample, if it's row number 2 that you put here, in the out-of-sample, the first row that appears here is row number 3. It's the row that follows here. It's this guy here. Exactly the next observation. So this comes here. So you always use to basically bootstrap in pairs. Yeah? So if you take, for instance, and of course, you lose one observation here, because let's say in the second iteration, you take the row at time t minus 1, and this is then your second row for the in-sample simulation. You would take the last row that follows, which is capital T, this guy here, would be then your second row in the out-of-sample. Yeah? So obviously, you can only have the last observation that you might have in the in-sample is obviously at term t minus 1. Yeah? So that's the way how it works out. What you do then is, okay, you have the simulated sample, yeah, in-sample, you run or you estimate the maximum squared Sharpe ratio for your in-sample. You keep the weights constant and have a look what is the maximum Sharpe ratio with this weight from the in-sample used in the out-of-sample. Yeah, that's basically what they propose to do. And this is what you see here. Yeah? The in-sample Sharpe ratio for the 6-factor model using operating profitability obviously is 0.177, and it's considerably higher for the 6-factor model using cash profitability. Yeah, we have 0.236. Yeah? And for the out-of-sample, it's almost 50% higher. So the out-of-sample Sharpe ratio for the 6-factor model using operating profitability is 0.108. Yeah? So the out-of-sample maximum squared Sharpe ratios are always lower. Yeah? Whereas the out-of-sample maximum squared Sharpe ratio for the 6-factor model using cash profitability is 0.159. Yeah? So we see from this simulation study here, irrespective of whether we use full sample, in-sample, or out-of-sample, in all of these 3 simulation studies, the maximum squared Sharpe ratio is higher for the 6-factor model using cash profitability than for the 6-factor model using operating profitability. Next, if we The difference, if you consider now only, let's just consider the full sample now, okay? Even though we know that this is biased, yeah? But let's just consider the full sample. The difference in maximum squared Sharpe ratios between the 6-factor model using cash profitability and the 6-factor model based on operating profitability is 0.208 minus 0.152, which is 0.056. Yeah? That's the difference in maximum squared Sharpe ratios. And what they report here is how often, if you do this, if you run this simulation here, and you have it for, you do the same for both data matrices, you can estimate in how many runs is this 6-factor model based upon operating profitability better than the 6-factor model based upon cash profitability. And it's 0%. In 0% of the 100,000 simulation runs, the 6-factor model using operating profitability would generate a higher maximum squared Sharpe ratio than the counterpart using cash profitability. And this result is also robust if we would consider in and out of sample simulations. Yeah? The difference is almost in the same magnitude here, the difference in maximum squared Sharpe ratios. And if you consider now the out of sample simulations, in only 2.2% of these 100,000 simulation runs, this 6-factor model using operating profitability performs better than the other one. But that is below 5%. So that can be just purely by chance. So what we can conclude from this table here is that, well, obviously, cash profitability, or the model based upon cash profitability, performs better than the 6-factor model using operating profitability. That's the outcome of our simulation study here. Here's basically, when I prepared the lectures, then I thought about, okay, how can I explain this in a manner? So I have made it basically, I try to explain it like this first. So, but I don't know. I guess this is more intuitive. But if you want, we can go through this in the lecture, in the exercise one more time. That's no problem. So then they raise in the paper the question, okay, are the values of the maximum squared Sharpe ratio for these top 3 models statistically distinguishable from those for other models or from one another? So basically what they do, it's basically the same question that we have already discussed, or that we can basically derive from this table here, where you want to know, okay, is the deviation in maximum squared Sharpe ratios, how is it statistically significant? Because this is what we cannot see, because if we just have the point estimates, these are just point estimates. Yeah? But here, what we see here is, here we see the frequency, how often this one model outperforms the other. And this is basically how the extension here of table 4. Yeah? They compare one model with different other non-nested models. Yeah? They compare one model with different other non-nested models. So for instance, we just consider here the upper part. Yeah? So we compare the color model. The color model it contains the market factor, size factor, value factor, cash profitability factor, investment factor, and momentum factor with, for instance, here in this row here, we have the model based upon operating profitability. Yeah? So, and we know already the difference in maximum squared Sharpe ratios is 0.056. Yeah? It's the same value that we have here in table 3. Yeah? It's 0.056. And we know already that the model based upon operating profitability in 0% of the frequencies is better than the other one. And this is also, of course, what comes out here in this table. Yeah? In 0% of the frequencies, this model based upon operating profitability performs actually better than the model, six-factor model based upon cash profitability. But here we have also other models. Yeah? For instance, interestingly, yeah, the maximum squared Sharpe ratio using just small factors here. Yeah? Now we just use small stocks for constructing our risk factors. So the maximum squared Sharpe ratio is 0.037 units larger for this factor model using just small stocks. Yeah? And in 91.3% of the simulation runs, considering just like full sample simulations, this model using small risk factors performs much better, obviously, than the standard model. Yeah. And if we now go here to out of sample simulations, yeah, the percentage is 80. It's still high, super high. So, in 80% of these 100,000 out of sample simulations, the factor model using cash profitability and small stocks only performs better than the standard model using small and big stocks. So this is the way how you read this table. Yeah? In how many times of the frequencies performs the model on the left-hand side here better than our column model. So now we get basically a feeling for the statistical significance of these deviations in maximum squared Sharpe ratios. Yeah? And in the paper, they argue basically that these three models here, they have the highest actual Sharpe ratios. Yeah? So that's why they compare these three models here against all of the other guys here. So, yeah, as a summary here, just the takeaway from table 4, spread factors or risk factors based on small stocks are better than the standard factors. Yeah. Then what they report here in table 5 are spanning regressions. So what they do now is, okay, in this table, they regress each of these risk factors of these 6-factor models. They regress it on all the other remaining risk factors. Yeah? This is what they do here. And then they check if the intercept is significant. So if the intercept of the spanning regressions here is significant, yeah, you see the t-statistic here on the right-hand side, this means that the corresponding risk factor on the left-hand side contributes marginally to the Sharpe ratio. Yeah. So once this corresponding risk factor here is accounted for in the model, the marginal Sharpe ratio or the Sharpe ratio, the maximum squared Sharpe ratio increases. So obviously, for all of the risk factors, apart from one, there's always like a black sheep, right? So the black sheep in this case here is the value factor. Yeah? If you regress the value factor on all of the other factors, you see that the intercept is 0.08 with a t-statistic of 0.90, which means the value factor is fully explained by the remaining risk factors. And this is also the result from the 2015 paper, so that's actually nothing new. But what is new is that once you regress the size factor on all of the other risk factors, including the momentum factor in this case, the point estimate is 0.48, and the t-statistic of the intercept is 4.35. So obviously, adding the size factor increases the maximum squared Sharpe ratio in the presence of the other risk factors. And we have the same result, or similar result, using spanning regressions for small spread factor models. Yeah, this is reported in panel B. So it's a similar. It's just confirming the results as reported in panel A. So these kind of spanning regressions you employ if you want to investigate. Okay, you have a model, you have a risk factor model, and you want to see, okay, which of my models are actually driving the result? Which of these models are actually contributing to increase the maximum squared Sharpe ratio? And in this case, it's obviously all of the factors apart from the value factor, which is the black sheep here. If you have seen my presentation, or if you have read this paper that I uploaded for you there in this Moodle page, then you might see, you might have figured out that if you employ option-implied volatility managing, the results are quite different. Yeah. Table 6 we can skip. Table 7 is also interesting, just in brief. So now what they do now is, okay, they employ different, now we go back to the beginning, now they employ different left-hand side portfolios, sorted by size and book to market, and so on and so forth. You can read it in the table description. And they employ this GRS test, this F test of the intercepts. It's a simultaneous test of the intercepts. And here you see, if you just consider here the panel A, that the GRS test is linearly increasing as we move from this small stock risk factor model to the standard 6-factor model using operating profitability. So it's basically a similar or the same result, but now we use the standard left-hand side test. And in panel A, they use, let's say, all of these test assets, and then in panel B, they use subsets of 5x5 sorts on market equity, book to market equity, and operating profitability, cash profitability, and momentum, and so on and so forth. So they just change they play around with what left-hand side test assets they actually are using here, But the outcome is the same thing, The GRS test is the smallest if we imply small stock risk factors. So the mispricing, we know already the GRS test reports sort of the average mispricing. So the average mispricing is the lowest employing a risk factor model that has small stocks. So that was it for today, I think. So the takeaway, to summarize, if we have now talked about left-hand side tests and right-hand side tests, then for using two different types of right-hand side tests, using either non-nested models or nested models. For this, if you have nested models, you can use basically this left-hand side test. It's where you use just this. You are testing the intercepts. You're regressing the additional regressors of the one-factor model on the risk factors of the other factor model, and then you make conclusions based upon the intercept terms. But once you have different risk factors or risk factors that are constructed in a different manner, then you have to use obviously the simulation approach in order to draw conclusions which risk factor model you would choose. Yeah. So if there are no more questions, I would like to end this session for today.